Hello, I'm Michael from Legacy. First, I wanted to thank all of the subscribers and for those people that were able to watch all of the videos for Final Expense. I certainly hope that they helped you close more sales. Today, we're going to be talking about mortgage protection. I'll tell you about the lead that we use, as well as provide you with the most common in-house presentation that you're going to run into while you're in the field working mortgage protection. The lead that we use is a direct mail proprietary lead. It's going to contain some information that's been pre-printed, as well as some information that the prospect fills out. They're going to fill out their name, birth date, height, weight, phone number, and whether they smoke or don't. The pre-printed information that's going to be on there, yes, it's going to have their name and address, but it's also going to include the name of the lender, it's going to include the amount of the mortgage, and it's also going to include the mortgage date. Now, those leads are always available to any of the agents that contract with us. They are always fresh, and they're the same leads that I use every week, which generate anywhere from $15,000 to $20,000 a month, each and every month, including November, December, and January, which, as you know, are some of the most difficult months for life sales. Now, if you belong to a group that can't provide you with fresh leads on a weekly basis, and can't give you triple-digit commissions for mortgage protection, then you need to contact us today. We want you to be part of the Legacy Group. For the in-house presentation, we're going to make a couple of assumptions. One, that we've set an appointment, and when we got there, we're now on our way to the kitchen table. So the most important thing you can do in any in-house presentation is to begin to engage those prospects. You want them talking to you, because one, it's going to make them feel a little bit more comfortable about having a stranger sitting at their kitchen table, and it's also going to begin to develop a level of trust. Once you've accomplished that, I always carry the leads with me. I'll pull out the lead, I'll turn it around, and I'll show it to both Jim and Jane and say, Jim, Jane, this is a copy of the information that we filled out and sent back. Now, if you're like most of the people that I work with, our main concern is to either pay down or pay off this mortgage, and God forbid if anything ever happens to us. Does that kind of sound like what you sent in the card for? Anytime I've asked that question, the answer is always yes. And that's a good thing, because that's a test close question. You want to make sure that they understand why you're there, what we're going to be talking about, and yeah, they're interested in finding out some information about that. The second thing is that you want to be able to get your clients to say yes, 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 yes as often as possible throughout your presentation. So when it comes time to the end, saying the word yes is just another comfortable way of just continuing right on with what's been happening the whole time you've been there. Once that's done, I'll say, okay, great. Let me tell you about what's going to happen today. I'm the field underwriter that got assigned to your case. Today I'm going to confirm all of the information that's here on this card, as well as I'm going to ask you some additional questions, and then we're going to come up with some programs that I know you'll qualify for, and then we'll see which one best fits you. How's that sound? Great. Perfect. Okay, so first, let me explain to you how mortgage protection works. In order for the lender to get the money to either pay down or pay off your mortgage, it's funded through a life insurance plan. And how that used to work was the lender then became the owner of the policy. They became the beneficiary of the policy. If something ever happened to you, they're the ones that got the check. And your surviving spouse or beneficiary either got a reduced mortgage or the house was paid for. Today, we can do things quite a bit different. We actually don't have to involve this lender at all. Now we can actually leave the money to a person. And now that person can decide what they want to do. At the end of the day, they're going to get a big fat check. So they can either march down to the lender, pay off the house, or they can use half the money to pay off the house, perhaps keep the other half to do something else that they want to be able to do. But regardless of what they use the money for, it just gives them options. And our goal is to try and make sure that we've provided enough money to pay off this mortgage if that's what they choose to do. So, because as we know, it is funded through a life insurance plan, so let me ask you, how's your health doing? The answer to that question in mortgage protection is almost invariably, oh, it's fine, it's great. And that's fine, but the next question that I always ask is like, okay, great. That sounds good. I'm glad you're healthy. Tell me, are you taking any medications? Well, yeah. Okay, well, what exactly are we taking? Now, when it comes with mortgage protection, generally it's just a few medications that are fairly basic. It's rare that you run into someone that's got a whole page full of medications. It happens, but it's rare. One of the other assumptions we're going to make today is that they're both pretty healthy. They're both non-tobacco users. And, Jim is taking, a couple high blood pressure medications and a cholesterol medication. Jane's not taking anything. So I look at the medication and say, okay, great. This looks fine. I see no issues or problems here. Let me ask you, have we, you take any inhalers or anything for asthma, COPD, anything like that? No. The reason I ask that question is for some reason, most people don't look at an inhaler as a prescription. So you always want to ask that question. And great, okay, that's cool. What about any heart surgeries like bypass surgeries, stents, anything like that put in? No. Great. What about cancer? Any problems there? No. Great. Cool. Now, those are some of the very knockout basic questions. So I usually will ask those right out of the gate. And then I can kind of continue on. It's like, okay, now let me tell you a little bit about the programs that we can offer. We're going to be looking at a term life insurance plan. And the reason that, today we're going to be talking about term in this presentation is that there are other programs available. There's return of premium programs that are available. Obviously, straight term. There's, for those people that do have a list of medications or perhaps are too old to qualify for a term program, we can use a simplified issue product to be able to provide some monthly income to help pay part of that off. There's a lot of different things to be able to use for that. So today we're going to assume that everything's copacetic, and now we're going to go on, from there. So, okay, great, Jim, Jane. There's a couple things that we can use and a couple programs that we can go for. First, though, let me ask you, what is your monthly mortgage payment every month? $500. Great. And that include your escrow, so it's your taxes, homeowners insurance, all that's included. Great. Okay. So we're paying about $6,000 a month. Perfect. Now, the reason I asked that question is right then and there is because even though it seems as though on the surface they're pretty healthy, we haven't asked any real medical questions off the application yet. So, we're still kind of assuming everything's good to go. If it isn't, and I have to pivot off of a term plan to get to a permanent plan, now I can do that because now I have this information. It's like, okay, so now let's move on. So, Jim, Jane, everything looks good, sounds good. If we qualify for it, generally the type of policy that gets used to cover mortgage protection is term life insurance. The reason we use term is because term has an end date. Your mortgage has an end date. If the goal of this policy is to pay off the mortgage, then once the mortgage is paid for, we don't need the policy anymore and you can just let it go. People can have and often do have several different life insurance plans, each one that has a specific goal. We get something for final expenses because we know that that's not going away. We're always going to have that issue. We're not going to avoid that. The second thing is our job site life insurance. And I tell everybody that I sit with, get as much life insurance from your job as you possibly can because you're never going to find anything cheaper. Then we get something like what we're talking about, and that's to cover mortgage protection. The reason that you can't keep job site life insurance once you retire is the same reason why at the end of the mortgage we don't need this policy, and that is that income is no longer there because we're not working anymore. We don't need the life insurance to cover something that we don't need. Same thing with this one. So, now we can kind of look at it and say, okay, so now Jim, Jane, that's typically what we use. Let's see what programs we qualify for, and then we'll know whether we can actually pay it off or pay it down. So, let me ask you, a couple questions. Now, for those people that are brand new to mortgage protection and using term insurance, you may want to grab what you think is going to be the carrier that they're going to qualify for, and then be able to ask a few more in-depth questions off that to make sure that that's what's going to happen. That would be advisable to anybody who's brand new. If you've done mortgage protection before, you're familiar with term life insurance, more often than not, you're going to have a pretty good idea on what's on those applications and the type of questions that are going to get asked, so you don't have to go through that. Also, to kind of help assist some of the agents that we have in the field, whether you're experienced or not, the tool that we provide everybody that contracts with us is called a Simplified Issue Term Appetite Guide. What this guide does is it takes all of the most basic health questions that are on there and health issues that you're going to run into. heart attack, stents, diabetes, arthritis, rheumatoid arthritis. All of those very common things that you have, and that's going to be laid out on a grid across with all of the carriers that we have that offer simplified issue term life insurance. And it's going to say, okay, high blood pressure, excuse me, 1 to 2 medications, standard. This one's got 3 medications. Okay, they're a decline with 3 medications. Oral diabetes, okay, if it's after 50 years old, if it's before 50 years old, might be a table 3, table 4 rating. We're going to have that all listed on one page. So it's real easy to reference and to be able to go through so that you have a really good idea of the carriers that you're going to be able to use. The next tool that is offered to all of our contracted agents is our quoter. And the quoter that we have will quote 10, 15, 20, 25, 30-year premiums for term life, return of premium, as well as no lapse UL. It's also going to include anything that you need to do for final expense, which would be a simplified issue plan. Oftentimes, simplified issue life insurance is used for mortgage protection because perhaps there's health issues, perhaps they're too old. There's many different scenarios where you might want to use that particular product versus straight term. There's going to be times when people want return of premium, but they're too old to have that rider included on their term life insurance plan, but there's other guaranteed universal life that provides cash out options. There's a lot of different products to be able to use. Those presentations will be for a different day. The assumption that we're making is that everybody's pretty healthy and we're going with a straight term product. So once you've decided on what that part's going to be, that being the coverage and the carrier that we have, now you're going to be able to look at Jim and Jane and just say, okay, it looks like we'll be able to qualify for all of the programs that I can offer you. So we can look at a couple different things here. We can look at, you said you had a 30-year mortgage and you're at $115,000, and we can look at either a 20-year part or a 30-year term. Either way, the reason I kind of suggest sometimes is 20 years. One, it's a little less expensive than 30 years, but it also means that if we looked at 20, and even though you have a 30-year mortgage and we're about a year into it, at the end of 20 years, if this policy runs out and you're still with us, okay, there's not going to be much left if something happens over the course of the next few years. If that surviving spouse has to go refinance the mortgage because now we may only owe $20,000. And now when they do that, they can certainly reduce the monthly premium to something that's very easily affordable for them and the family. So that's sometimes why I suggest to you, 20 years might be okay. We can look at certainly 30 years, and at the end of 30 years, it's going to cover every single dime. The good thing about these programs is that regardless of which one you choose, 20 years or 30 years, it's going to be there, the same benefit, the same cost for the entire time. So it doesn't matter if you had a 30-year term or a 30-year program and 25 years into it we've passed away and our mortgage might only be $15,000. All that means is that now your surviving spouse and beneficiary is going to get a big check for $100,000. They just get to keep the difference once the house is paid for. So let's take a look and see where we're at. Now, once you've gone through and started quoting out your carrier, you're writing things down. For this particular case, they have a $115,000 mortgage. I would show them $100,000, $115,000, and I'd show them $150,000 just in case they want a little bit more insurance. I'd also show them the cost difference between 20 and 30 years, and I would do that for both of them. So you write that out on the lead, keep it as neat, legible, and as organized as you can. Now, when you're ready, you're going to flip this around and say, okay, here's what we have. Jim, here's you. Jane, here's you. I started at 100,000. I've got 100, 115, and 120,000. Here's 20 years and here's 30 years. You folks tell me, which one of these do you think works best for you? Sit back, stop talking. Let them talk amongst themselves for a couple minutes. They may ask you some questions in between there. Once they've started to look that over, they've started to discuss a little bit, I'll kind of interrupt their train of thought and I'll say, here, let me also tell you this. Term insurance today is much, much different than it ever was 20 or 30 years ago. There's a lot of living benefits that now come along with whatever policy and whichever program you decide to choose. So, for example, if we ever had a heart attack, stroke, maybe unfortunately we ever get cancer, you're allowed to accelerate some of those benefits so that you can use that money to either pay your deductibles on your health care, pay mortgage payments, some bills around the house, kind of do whatever it is you'd like to do. It's kind of a neat benefit to have. And just so you know, when we do that, obviously we're going to be reducing that face amount. So let's say we had a $115,000 mortgage, but we'd like a little extra just in case. So you have $150,000. Well, maybe we've accelerated $25,000 of it. Now we've got $125,000 in a death benefit. Well, that premium is also going to be reduced to now reflect a new death benefit. And each time you accelerate benefits, the premium gets reduced to match whatever death benefit is left. Okay, great. Now I stop talking again. And they'll look at it and they'll put it down and say, okay, which one do you think works best? Well, we're going with this one. Perfect. Now it comes time to just facilitate the application. So once that happens, we encourage everybody to use electronic applications as often as possible. You can't make many mistakes with an electronic application. It just doesn't let you go on. The worst thing you can do is spell somebody's name wrong. But otherwise, you can't forget a check off a box. You're not going to forget a signature. You're not going to forget what you need. That's number one. The second thing is that once you're finished, you just click a button. It gets submitted to the carrier right then and there. And that certainly saves you a lot of time in the office, having to put together those applications, scan them in, send them by email or fax them, whatever it is that you do. So those reasons we always encourage people to use electronic applications. Once the application is finished, you need to present them with a company brochure of the carrier that you chose for them. And I encourage everybody to get the company brochures that they have. Each carrier has them. They're free to contracted agents. And it also looks a heck of a lot more professional than using something that's printed off your printer. You're also going to present them with a business card. You're going to tell them that, I'll keep you informed along the way, make sure everything goes through underwriting okay and we don't have any problems or issues. If something ever comes up, I'll certainly give you a call. Just so you know, the carrier themselves, they may also reach out to you to answer any questions that you might have. I would probably say we're looking at about a week or two before we get an answer at the longest. Some people go a little faster. It just kind of depends on where the carrier's at. But that's kind of what I would expect it to see. And then you're off. The thing that I don't do is thank them for their business. They're thanking you because you're there to help them. And if you did your presentation correctly, you've educated the client on what mortgage protection is about. We've educated them on the product that they have. We've explained everything to them. We presented them from a program. But at the end of the day, they made the decision. They made the choice to choose this. When it comes to sales, it doesn't matter, what it's going to be, but especially in mortgage protection, it's always, nobody wants to necessarily buy life insurance, but they need to be sold life insurance. If they make the choice and you've done your presentation well, then they're taking this presentation, they're taking that policy, they're thanking you because you've just taken a monkey off their back. They wanted something in place to pay off their mortgage in case anything happened to them, and you just provided that for them. So you're off and you're done. So if you like what you heard and you want to learn about other mortgage protection presentations that are certainly going to give you every opportunity to make a sale in every household that you set an appointment, then give us a call. Or you can email me directly through legacyagent.com. At the end of this video, we'll provide you with a link in the email address to do that, and we'll be able to get the contracting process started. So have a great day.